Well, surprisingly, tariffs weren't really the surprise. Hey,
John
Brian.
Kajid, how are you? Nice to see you.
Good to
It's
see
been
you.
a very, very long time.
It
actually.
has. The marketing guys said, "Oh, you're going to be working with Brian." I said, "I'm not Brian Parker." Yeah, it's great because, I think, we manage a lot of money for you guys.
You do.
and
And you do a fair job of it too, by the way.
Oh, thank you. We try.
We're pretty happy.
We try.
Yeah, absolutely.
The chance to work with you directly on this kind of collaboration.
Very, very
Love it.
exciting.
Love it.
Let's have a chat.
Yeah, let's have a chat.
Let's talk about markets, because it's not as if there's that much to talk about, but
no.
it's been pretty quiet.
Yeah, very
Pretty dull
quiet.
year.
Very, very quiet.
So if you think about over the last 2025 to date, for you, what's the big surprises, positive and negative? What's been, front of mind for you guys at State Street?
Well, surprisingly, tariffs weren't really the surprise. The bit that surprised me, Brian, was actually not in the US, it was actually in Europe. The Germans have had a thing for a long time where they have strict rules to balance their budget. And we had wondered at the start of the year whether they might perhaps be loosening those rules up. And they did in fact do that. It's
Yeah,
called
to me that's a big
German-
game changer. It
The
is.
German debt break.
Yeah, absolutely. I mean, to me, I look at Europe, and there's one thing that Donald Trump, I think, has been consistently right about, is that when it comes to things like defence spending, for example, Europe has been pretty much free riding off the US taxpayer for 70 years. And Ukraine has been a huge wake-up call. It's almost like the Germans have been a bit sort of, in many ways, kind of delusional about Russia. This idea that, no, it's all business, we can do business with Russia, everything's fine. And not even Crimea seemed to wake them up, but now Ukraine kind of has. And you get a very, very strong impression from the new German Chancellor that this has been an absolute game changer for Germany.
Yeah. And what's interesting is it's not just defence.
No.
It's infrastructure as well. And the headlines and the geopolitics around the headlines, which might have driven the fiscal decision, is quite different to the flow-through impact of the European economy. So you've had this geopolitical situation and this headline that now means Germany's borrowing and spending money, and that's starting to have an impact to flow through into European markets.
Do you get the sense that, I mean, we tend to be very much valuation driven in our country allocation, so in our active asset allocation modelling, and being a European fan on valuation grounds has been a fairly challenging place to be honest.
It has.
It's almost like this is Europe's moment. It's now or never really for Europe, both in an economic sense and a geopolitical sense, I guess.
Yeah, it's funny because when we had all this disruption at the start of the year, if you look at the kind of underlying economic growth we were looking for over 2025, fast forward to now, we've probably taken 0.5% off most developed regions, with the exception of Europe. We haven't had to cut Europe because of that, as you said, that kind of new vibrancy. And the European equity markets year to date have done better than the US, and the euro was strengthened against the US, so it's been a pretty positive story. I think longer term, there's a question of profitability, there's a question of innovation. There are the kind of industries that Europe is exposed to, and it's still struggling a little bit when put up against the US. The US is exceptional for all a number of reasons.
I know, and that's an interesting one. And something that's been a bit of a live debate internally here at ART is this idea of US exceptionalism in an investment and economic sense. And when you look at equity market performance, again, being underweight the US has been equally as frustrating as overweight Europe. But you look at US corporate valuations, you look at US returns on equity, and these companies are insanely profitable. Pretty much every industry sector in the US trades at a premium to the rest of the world and has done for a while. And they're delivering higher returns on equity. Pretty much every US sector delivers higher returns on equity than the rest of the world. The interesting thing too for me is just the difference, and I'm getting a lot of questions from members about this too, about, look at US politics and the Liberation Day announcements. The analysis behind that, and I use analysis kind of in inverted commas because they were just really made up numbers. You just certainly got the sense that the grown-ups were not in charge at that point. But to what extent can we distinguish between the US as a political system, which is, shall we say, challenged, and the US as an economy and an investment destination.
Yeah.
At the end of the day, this is still the biggest, most dynamic economy in the world.
Yeah, yeah. I think you make a good point. The headlines are not the same as what's happening in the underlying economy, and what's happening in the underlying economy doesn't flow straight through to share markets. Share markets sometimes move in advance and sometimes move behind. And I think the administration, the analogy we've used internally is they're very keen to rock the boat, but they don't want to capsize it.
No,
And
but
they're
it's a
not,
very delicate game,
it's
though.
a delicate balance,
game.
you know. Bit of water over the edge of the rail on the side of the boat, but they've been a little bit sensitive to what markets are telling them if they've kind of overstepped the mark a bit. And I think markets are now seeing this as we've got a lot of uncertainty, and that means things have been put on hold to some extent in the US in terms of business investment or hiring decisions. It's not like everyone's running for the exits and the boat's sinking. Everyone's just sort of, things are on pause. And so we actually think the underlying economy will probably pick up towards the end of this year and into next year as that peak uncertainty kind of unwinds a bit. Businesses start to feel they've got a bit more of a handle on how they're going to invest. Do you think, you've sort of expressed the view that you think Australia is reasonably well positioned? How are you seeing growth in Australia this year, next year?
Look, I think it probably gradually improves. I don't think we're going to race away or anything like that, but I do see, finally we're starting to see real wages growing again. So people's real purchasing power is starting to improve, and I think people are starting to realise that that's happening. It takes time for people to actually catch up with the fact that actually those cost of living pressures that really hit me hard coming out of COVID are now starting to ease a little bit because inflation is coming down and real wages are now rising again. I think that does bode well for consumers over the coming year or two. I still think there's a fair amount of caution out there, but I think you will see a bit of a pickup in consumer spending. I've been really impressed by the sort of business investment intentions holding up. And there's still an awful lot of work happening in the infrastructure space, especially in the energy transition space, where you've seen this massive surge in the pipeline in that space in the last probably 4 or 5 years, and that work is going to be ongoing. So I do get the sense that we still have I still think we still have a tight labour market. The pressures have eased somewhat. But we still have a situation where skill shortages are still apparent. There's still a shortage of tradespeople. We desperately need to build new homes. We need, if we could build another 250,000 homes tomorrow, that would be wonderful. But the people who could conceivably build those homes are tied up doing other things. And how we resolve that, I'm not really sure. So I think that the housing story still remains a real challenge for me. Housing affordability. Mind you, to be fair, if you happen to have the right parents or grandparents, then you can afford a house no problem. But we've become a country where your ability to be a first home buyer depends on that genetic lottery of life, which I think is rather sad. So how are you positioning portfolios? What state streets, where's your overweights, underweights? Where are you seeing the best opportunities out there?
Well, it depends, which is a classic.
Yeah, it's a classic economist.
A classic.
I thought you weren't an economist, you're an actuary.
Actuaries depend more than anyone else. So it depends, and it depends on what your time frame is. So, if you're looking at 10 years and you're working with a financial planner and you're setting a kind of a long-term strategy, you're probably talking something like maybe 6 to 7% for equities would be a reasonable long-term number. Don't be thinking 10 to 15s. US Treasuries, something like 4 to 4.5%, so you might give up 2 to 2.5% by being conservative, but it's only a third the risk. So I think, long term you work with your financial advisor, how much of that 2% per annum do you want to pick up in order to sort of triple the risk of your portfolio? So that's one trade-off. When you get a bit closer, sort of out to a year, we probably prefer the US and emerging markets over Europe and some Asia Pacific countries, which sounds odd given our earlier comments about the dynamism in Europe, but that comes back to where earnings are trending, where sales are trending, the kind of turnaround we're seeing in profitability in US companies. And shorter term, and these are the sorts of things that I'm sure Australian Retirement Trust is doing, changing positions quite quickly. For those shorter term time horizons, we're actually quite like equities at the moment. But that could change next week.
Absolutely.
And a
Absolutely.
lot of that depends on the risk appetite for markets. And we think right now the indicators we're looking at say markets are comfortable with risk. They've got more and more comfortable with risk. That combined with improving earnings in the US in particular means we quite like equities. We don't like bonds. In just short term, maybe shorter duration bonds, perhaps high yield, maybe floating rate securities, those kind of securities we like. We quite like a bit of cash in reserve, quite like commodities and gold, bit of a diversifier off to one side. So those are the sorts of positions that we've got in those very fast moving portfolios.
And I think given the last few months, we've certainly taken advantage of volatility. I mean, Liberation Day was a classic example that we went into Liberation Day being a little bit conservative, a little bit underweight equities and overweight bonds, did quite a bit of buying in the days after Liberation Day. We honestly thought we'd be building a position over time because we had the luxury of being able to take a longer term view. But we certainly didn't expect that Trump would change his mind quite quickly. And so we ended up pretty much back where we started within about 2 or 3 weeks, which is quite extraordinary. But those sort of periods of volatility do provide some opportunity, which we're happy to take when they present themselves.
That was an extraordinary rebound.
Oh, absolutely. I think
The speed of that was just...
I mean, it's interesting to me, and you touched on it before, that as much as Donald Trump claims to not care about the stock market, he clearly cares deeply about the stock market. It's like his own personal approval rating. And, you know, when people got in his ear and said, the more you speak, Mr. President, the further down the stock market is going, maybe a change in tune sooner rather than later was really on the cards. But yeah, it was still a phenomenal turnaround.
Yeah.
Phenomenal turnaround.
And I know at the time, lots of market watchers were also looking at what was happening in the US Treasury market and to the US dollar. And there was some particular patterns of movements that for old hands in the market, I mean, we're young hands obviously,
Yes, correct.
but for old hands in the market looked at that and said, oh, that looks a bit of a way. And I think there were a few whispers in the White House here to say, just be a bit careful here.
Yeah, absolutely. Jonathan, thanks heaps for coming in. It's great to catch up and talk about markets with you after all these years.
It was fun, wasn't it?
Yeah, absolutely. We'll do it again every quarter. So very much looking forward to the collaboration. Thanks, Austin.
We'll have another quiet quarter. Maybe
not
a
much to
quiet
talk
beer
about.
at the end of the quarter, you know.
That'd be
Nothing's
really
going
good.
to happen this time,
No,
Brian.
it'll be very, very quiet.
Yeah.